My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but it's to put things like this in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Welcome to the bizarro stock market, where the good ones get slaughtered and the bad ones skyrocket. And that's exactly what happened today, where the Dow sold off 121 points, S&P tumbled 1.31%, the NASDAQ nosedived 2.7%. That's a two-day decline of 4% for that index. Because we've reached the point in the business cycle where the companies with the worst numbers suddenly have the best stocks. And that's thanks to J&J, Moderna, and Pfizer. Because we're on the cusp of a post-COVID boom that now looks to be pushed forward, happening much sooner than expected. That's what today was about. Now, like I've been telling you for weeks, money managers now want the obvious reopening plays, the ones that are in terrible shape, but could be huge winners as the world goes back to normal. Airlines, cruise lines, hotels, second-rate retailers. Meanwhile, anything that was like last year is now despised. I mean, hated. When the economy went into lockdown last spring, the essential retailers caught fire because they were the only ones allowed to stay open. How could they not have? So Costco, Walmart, Target, Home Depot, Lowe's, pretty much everything else was forced to shut down, not just mom and pop outfits, but a lot of specialty retailers like Michael's Stores, the arts and crafts chain where I always used to take my youngest daughter. Now, though, these tables are turned. The essential retailers have lost their mojo. It's a technical term. While the specialty players have come roaring back. A year ago, the Michael's companies, Michael's Stores, get this, saw its stock trade down to $1 because who needs art supplies in a pandemic? Today, got a $22 takeover bid from Apollo. Same story with Kohl's. Last year, nobody wanted it. They got rid of the dividend, took down a big slug of debt, and stock sunk to $10. Most of the stores shut down. Now Kohl's is at 58 with the dividend reinstated and an activist hedge fund shaking things up. Okay, insult to injury. Look at Nike, one of the great success stories of 2020. Despite a worldwide pandemic, they made a fortune by selling directly to the consumer over the internet and doubling down on China, which reopened first. But in 2021, this stock gets no love. You know what is rallying instead? Where they sell the shoes. Foot Locker. Yes, the shoe store just reported a terrible, miserable quarter. Huge miss, without much hope for the future. So it rallied 2.25% today. All right, remember Bed Bath & Beyond? This bow wow traded down to 3 smackers last spring, and the short sellers cleaned up on it. Kind of like the GameStop. But then I know it's GameStop. I did that to irritate you. But then an activist hedge fund pushed out the old management at Bed Bath, bringing in the brilliant Mark Tritton from Target. Now the stock's back. It's up to $29 after a mini GameStop short-busting moment. Briefly took it to the 50s in late January. Wow. That. Then there's Royal Caribbean. Okay, this is a cruise line that's not allowed to cruise. The stock bottomed at $19 last year. Management was recently able to sell nearly 17 million shares at $91, okay? It's earlier this week, based on the belief that they'd be able to sail again sometime soon, maybe. And when they do, they'll be up against insanely easy comparisons because, well, hey, nobody's sailing now. It's been a total juggernaut. You'd think buyers would be stuffed to the gills after this rally, right? Would they already have too much Royal Caribbean? No, think again. Everyone who bought on this gigantic offering that they just did at $91 is now up. Yeah, because it jumped to 94 and change. My favorite cruise line, Norwegian, hasn't really had a bad day in months. It's up another 6% today because the vaccine rollout is ahead of schedule. And I don't see it stopping anytime soon. I guess the secret to a higher stock price in this market is to do no business at all. Hey, you want really crazy? And I know these things. United Airlines announced today that it's selling up to 37 million shares to help pay for all the new planes it wants to buy. What happens? The stock rallies 2.5%. This market will forgive anything from the reopening plays. Meanwhile, when a fast-growing tech stock like Roku offers $1 billion of stock as it did today, it gets clobbered, immediately losing 5% in one day. That's why my favorite stock right now is the hapless, hated Boeing. I think if Boeing actually did an offering, they offered stock right now, its stock would actually go higher. Now, I don't want to do that, and they don't have to do it. But Wall Street's forgotten about the past. It only cares about the future. A future where surging travel demand forces the airlines to buy lots of new planes. This is going to happen. What else? There's a whole basket of industrials that I can't get enough of. These are the classic smokestack stocks. General Electric, Emerson, Eaton, Honeywell, Rockwell Automation, Raytheon, Nucor, 3M. Those cannot be denied. They can do anything they want. How long can this go on? That's what you're worried about. That's the big question, because the market has become totally zero-sum. Money managers sell last year's winners to raise capital for the reopening names. There simply isn't enough cash to go around to allow both groups to rally at once. As long as interest rates keep rising based on the great reopening and the potential for even more stimulus, and they soared today, we can expect this pattern to continue. Plus, we've got so many high-flying software-as-a-service stocks that help make customers happy while they onboard you and get IT to work, analyze data, and make decisions, obvious sources of funds. And that's why the Nasdaq keeps getting hammered, as it always does when long-term interest rates go higher. So many of the Nasdaq stocks, wow, they trade on the hopes of future earnings. But those hopes are worth less when you've got rising interest rates that signal higher inflation. And that's what's happening. Meanwhile, the rest of the market struggles to make headway because we have too few companies that actually make tangible things. So they keep bidding up those few companies. Here's the thing. This is a pretty textbook rotation, and it does have a limited shelf life. That's the good news for all of you who are thinking, oh, my God, I can't take it anymore. Like I've been saying for weeks, this period reminds me of the late 2015 and early 2016 period when the economy overheated and we threw away the same tech stocks we're throwing away now. It was even more vicious then. The problem back then was that the Fed was actually tightening, so you couldn't really root for the cyclicals that need a strong economy to work because the Fed was trying to slow them down. Eventually, the Fed tightened enough, put the big kibosh in the economy, and it became safe to swap, yes, into the very stocks you're selling today, the growth stocks. In short, this rotation ends when the economy hits a wall and long-term interest rates stop going higher, or at least take a breather, which could give you a chance, if you get one tomorrow, to do a little selling. Because the 2015-2016 scenario that I keep talking about will take a little time to play out. Why? Because the Fed this time has been adamant that it won't be raising short-term rates anytime soon. That takes away from that Janet Yellen raise, although, of course, people feel Jay Powell will capitulate when we get the big stimulus and we get the reopening. Now, once we get a cathartic collapse of epic proportions, as some people think we will have it in a single day, that's what we call a whoosh down instead of this drip, drip, drip. Then you can swap back from the boom and bust stocks to the consistent growers. Let me put it like this. We've never really seen a run like this in travel and leisure or the industrials, particularly travel and leisure, because we've never, of course, been closed down for a full year. But we've absolutely seen sell-offs like this in the high multiple tech stocks quite often. And they tend not to crescendo to a bottom until we have rate hikes, a slowing economy, and some high-profile blow-ups. None of these is likely anytime soon, though, although you can certainly expect some bounces along the way, as rates never go up in a straight line. These companies are doing so well that there will come a time when the selling abates a bit and you get a knee-jerk rebound, as you did several times in late 2015. And before the big whoosh down that you got in February, there were many times to sell. Maybe you avail yourself of them. Do you sell all the things tech and swap into planes, trains, automobiles, industrials? Not to mention the newly red-hot oils. You know I like Chevron and Pioneer every night. They're the only two I'm willing to recommend. Frankly, if you're nimble enough, that's okay. I'm game. You're up a lot. We've been scaling back on the tech names for my charitable trust for weeks now, replacing them with industrials, because that's what you do at this point of the cycle. But if you can't be nimble, if you're not confident you can swap back into tech at some lower level that's close to the bottom, then don't try to dump your whole position. Scale back on your favorite tech stocks so you can buy more at lower levels. You'll have room. And this is something I'm going to be telling people in my ActionAlertsPlus.com club call tomorrow at 11:30. Scale back. You'll have room. Bottom line. I know it's tough to just stand there and take punches. Isn't it awful? I think these well-run companies that have thrived during the pandemic, they always come back. But their stocks won't start rebounding until the Fed tightens or the economy slows for some other reason. And that could be a long way away if the economy reopens on schedule and we get a stimulus package. Of course, you know what we have to hear. We have to hear fang dead, fang dead, fang dead. And, of course, and what really has to happen? Well, Apple. In the meantime, we've got a glut of tech stocks and a shortage of cyclicals. Right now, you got to go with the shortage.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.